to the commission is how these measures affect property taxes. Interestingly, despite there being different parameters, all of the measures that do not include a step down, so that group that either has cuts in the res and non-residential assessment rates, sometimes with subtraction, sometimes with steeper cuts in the residential rate if a subtraction isn't in the ballot measure, have very similar impacts in terms of our assessments, in terms of how much they affect overall property tax revenue across the state. So we assess all of those measures that don't have a phase-in, the first 13 of the 18 or 14 of the 19 that I showed you on the previous slide, as reducing property taxes by between $3 billion and $3.1 billion per year beginning in PTY 2025. Now, to explain what I mean, I think that folks who've been around the legislature will understand this. Our analysis is always comparing the amount that we expect to be collected under the proposal to what we would be expecting to be collected under current law. On occasion, you'll hear an argument that, well, it's not really a $3 billion cut because under current law, we would expect revenue to increase in property tax year 2025. And so the amount of the cut is less severe than is being represented here on a year-over-year basis. Our fiscal notes will always show the change relative to current law as opposed to the change relative to the prior year. And so that's what's being represented here. The impacts of the measures that are phased in will be less in the initial years. We're working on those analyses right now, and I know Mr. Hansen actually sent me some for review shortly before the meeting. So that's still very much a work in progress. At the end of the step downs, the assessment rates in these measures end up being a little lower than the ones that make the initial assessment cuts right away. I'll talk in a moment about how this affects funding for non-school district locals. Something that garners a lot of attention here at the Capitol and that I know the Commission's well aware of is the impact on school finance, because that requires a backfill under state law, regardless of how the proponents address any other backfill requirement. And so the total program obligation is increased at the state level by between $800 and $900 million a year in the course of any of these individual measures, depending on which one is going to produce the specific amounts. So many of the measures include requirements vis-a-vis a reimbursement or backfill requirement for the lost revenue that affects non-school district locals. Initiative 108 requires the total amount of lost revenue to be reimbursed. The majority of the initiatives include language requiring a reimbursement to the extent that it's practicable and don't provide additional clarity on what exactly that means. And then there are 5 measures that don't handle a reimbursement obligation at all, though of course the school finance obligation would continue to apply because that's a condition in current state law. So that completes my discussion of the assessment rate provisions of these measures. Some measures only adjust assessment rates, and you can see that spelled out in the memo. But there are measures that combine an assessment rate adjustment with a limit on statewide property tax revenue growth. So this appears in 7 measures. Most of these function in the same way. They say that when property tax revenue is projected to grow by at least 4% across the state, so comparing 1 year of state property tax revenue to the coming year of state property tax revenue, statewide voter approval is required for local governments to retain and spend the amount that they collect over 4% growth from the prior year. In one measure, Initiative 50, the one that's already qualified for the ballot, this is a constitutional voter approval requirement. In the other 6 measures, the voter approval requirement appears in statute as opposed to the Constitution. Some measures have exclusions where they'll say revenue growth that's attributable to certain instances is not subject to this 4% growth limit. In 6 of the 7 cases, property reclassifications are excluded from the limit. And in 2 of the 7 cases, the new operation of a taxing district that uses tax increment financing causes revenue gains to be excluded from the limit. The fiscal impact of these measures depends on revenue growth rates and voter authorizations. One thing that LCS doesn't have a good grasp of is how mill levies change over time, because this is overwhelmingly a matter for local policymakers to decide. assuming that mill levels, we actually don't anticipate 4% property tax revenue growth in the 2025 or 2026 property tax years, because we have offsetting changes to assessed values with different performances in the housing and commercial real estate markets. So our fiscal analyses for these measures don't anticipate a significant additional revenue loss attributable to these limits in the short term. But over a longer period of time, there will certainly be reassessment cycles where revenue would grow by at least 4% in those years. That could also be the case sooner. For example, if the legislature or voters enact some kind of a short-term cut to property taxes that applies in tax year 2024, for example, that could cause these limits to be more effective in cutting taxes for 2025 because they'd be looking at a lower base year to which those the 4% growth limit would be applied. There's one measure, Initiative 97, that changes property assessments and limits property assessment growth. I'll note just as a procedural matter, this is an initiative, along with a few of the initiatives in the next group, that was filed kind of a while ago, has had a title set and hasn't moved forward in the process beyond that. So it's not clear whether this remains a priority for the proponents who brought this measure. This is a constitutional limit that determines property valuations based on their most recent sale, if those properties have been sold since June 2020, or at the level of their property tax year 2021 assessment if they haven't been sold since June of 2020. And so this effectively rebases most property valuations to the level that they were at before the most recent reassessment, when we saw large increases in actual values across most properties. Annual increases under Initiative 97 are limited to either inflation or 2.5%, whichever is less. There is an exception to this if the property undergoes substantial improvement. We estimate that Initiative 97 would reduce property taxes by $2.3 billion for property tax year 2025 and by larger amounts in later years. Finally, there's a measure that's now before the title board for title setting on Wednesday that is a limit on growth in parcel level taxes. This is a constitutional limit, and for 2025 and later years, it would limit the growth in tax on any property parcel to no more than 4% per year. There are exceptions if, for example, the square footage of the property increases by 10% or more, meaning that the property owner completes improvements that increase the improved square footage by at least 10%, or if a local mill levy increase is approved by voters. It also says that if a property's taxes grow by less than the 4% limit, that the increment by which taxes were permitted to grow but did not actually grow can be carried forward and applied as a later growth increment in the amount of the property taxes. We're in the process of producing a fiscal analysis for this measure. We haven't completed that yet. All of those need to be completed by Wednesday's title board meeting. So that's the first group of measures. Remember, I captioned those measures to cut or limit property taxes. There are 5 measures that are also in the process that would limit the impact of property tax limits. 4 of these measures expressly address circumstances in which a property tax limit has been enacted. One other measure is clearly related to that while not explicitly addressing the existence of a limit. So these are 5 measures. They're all from the same proponents, Scott Wasserman and Ed Ramey. 2 of them conditionally impose taxes on what the measure calls luxury residential property. One conditionally increases the non-residential rate that applies for most non-residential property. One allows the state to retain and spend revenue over its Tabor limit to perform property tax reimbursements to local governments for their lost revenue as a result of the limit. And one requires local voter approval in order for a statewide limit on property taxes to apply locally. So there are 2 very similar measures that handle this luxury property tax issue. Because they impose a state property tax, they are constitutional measures, in part because they need to repeal an existing constitutional prohibition on this type of taxation. They say that if a statewide limit on the amount of or growth in property tax revenue is imposed, a supplemental tax would be imposed beginning in tax year 2027 to offset revenue loss that would otherwise occur. And so the amount of the tax is applied so that it generates revenue to fully offset the amount of the tax revenue loss attributable to the limit. In Initiative 96, this applies to single-family residential property worth at least $2 million. And in Initiative number 260, this applies to single-family residential property worth at least $5 million. Was an example of an initiative that had gone through the title board process kind of a while ago and not moved forward. I should probably assign that same caveat to initiative number 96. That one's been titled for a while, but hasn't moved forward beyond the title board process. For these measures, LCS isn't able to identify an immediate fiscal impact without knowing the revenue loss that would be attributable to a limit, which would trigger this tax. Though I would note that if we're trying to make up the amount of lost property tax revenue statewide by simply apportioning that revenue loss across residential properties worth $5 million, we're going to be increasing the rate of taxation that applies to those properties by an enormous amount in some instances where we're trying to make up, say, $3 billion in revenue loss this way. Initiative 269 is a different measure. It begins in property tax year 2026, and it cares about school funding. So it looks at total program funding for school finance, and specifically the ratio that is contributed by local governments as opposed to the state government. So if the local share of total program funding for schools is less than 50% in a year, this measure, Initiative 269, would increase the non-residential assessment rate that applies to most non-residential property to 32% from its current law 29% long-term level. The increased rate does not apply to property that's being used by businesses that meet the Small Business Administration's definition of small business. So that's an exclusion that's in the measure. Interestingly about Initiative 269, while this would trigger in many cases where property taxes are cut, we actually expect that Initiative 269 would be triggered under current law, even if there's no downstream property tax cuts that are enacted by the legislature or by voters. And so with voter approval, Initiative 269 would increase the non-residential assessment rate and would effectively be a property tax increase if it's not offsetting some other cut. We're in the process of creating a fiscal analysis for this measure. Obviously, there aren't great statistics available on the amount of property that is used by businesses that satisfy this definition of small business in federal rule. Two more measures here. Initiative 261 is a voter-approved revenue change. So it's a statutory authorization for the state government to retain and spend revenue in excess of its Tabor limit, or the referendum CCAP, in order to fully reimburse local governments for revenue losses that result from the imposition of a property tax limit. And so the conditionality here is if a property tax limit is approved, then the property tax limit presumably reduces revenue. We would determine the amount of the lost revenue, and the state would be permitted to retain and spend that amount of money in order to fully reimburse those locals for their revenue losses. As with previous measures, this fiscal impact is uncertain and would depend on what limit, if any, is imposed. The last one here is Initiative 95. This is another measure that's been through the title board process for a while, but hasn't moved forward beyond that to the signature collection phase. This is a constitutional measure. It says that if a statewide limit on the amount of or growth in property tax revenue is imposed, it would require local voter authorization for the limit to apply locally. So there would be some state election to impose the limit, likely on one of the ballot measures that I've already talked about this afternoon. And then downstream of that limit being imposed, there would need to be subsequent elections for the limit to actually constrain the amount of local revenue that a district would be permitted to retain. As with the other measures, we don't know what the fiscal impact of this is unless we know what the limit is and how voters at the state level are behaving. And then, of course, how voters at the local levels are behaving. So, Mr. Chair, those are all of the measures that have moved through the initiative process to this point and remain active. I'm happy to take questions from the commission now. I want to provide two additional caveats here. One is that while I'll do my best to explain the initiatives, I'm not the author of these initiatives. I'm certainly not the sponsor of these initiatives. And so my familiarity with them is limited to what is in the text of the initiatives themselves. Some initiatives are pretty vague about how their implementation would work. And I'm going to do my best to avoid just speculating on that where the initiative doesn't grant additional specificity. The second caveat I wanted to give is, unfortunately, I myself need to leave the commission's meeting this afternoon earlier than usual. And so if there are questions that you anticipate wanting to ask me later this afternoon, I'd encourage you to get those in now so that I have a chance to opine on them before leaving.
All right, Mr. Zabetsky, a tour de force as always. Thank you for a very well-structured summary of what is before or has been and is currently before the title board. Members, we have the pleasure of Mr. Zabetsky's company for about 20 more minutes or so, if I heard you correctly, and would love to take advantage of that. So let me open it up for questions from the commission on any of the material you just consumed. Commissioner Terry.
Thank you very much, Greg. My question is on the 4%, is it statewide? Is it regional, geographical, or is it state revenues, or is it all? What I've struggled with what that 4% is.
Mr. Zabetsky. Thank you, Mr. Chair. Thank you, Commissioner Terry, for the question. As authorized in these measures, or as contemplated in these measures, the 4% limit would apply to growth in property tax revenue that occurs in all jurisdictions across the state. So as the commission is well aware, the state government itself doesn't assess a property tax, but we would aggregate the total amount assessed by jurisdictions throughout this 4% trigger would limit the amount of